If you ask most beginner investors why a stock went up or down, you'll hear things like good news, bad earnings, or people are buying. But the truth is, markets don't move the way most retail investors think they do. And misunderstanding, this is one of the biggest reasons beginners lose money. So in this video, we're going to cover 5 things retail investors still don't understand about the market. And once you understand them, you'll instantly think about investing differently. 1. The market is forward-looking. One of the biggest beginner mistakes is reacting to news. A company announces great earnings and the stock drops. Why? Because the market already expected those earnings. Stocks move based on future expectations, not what just happened. By the time news hits social media, financial TV, or YouTube, the big institutions have usually known about it for weeks or months. That means retail investors are often reacting to the past, while professionals are already trading the future. 2. Price is driven by liquidity, not just fundamentals. Most beginner investors think stock prices move because a company is good or bad. Fundamentals matter in the long run. But in the short term, liquidity and positioning matter more. If large funds need to reduce risk, they sell, even great companies. If there's excess cash flowing into the market, prices rise, even mediocre companies. This is why sometimes the entire market moves together, regardless of individual company performance. The market is a giant liquidity machine, not a perfect scorecard for businesses. 3. Volatility is normal, not a signal. Retail investors often see volatility as a warning sign. A stock drops 5 panic sets in. But volatility is simply the normal movement of markets. Even historically strong companies regularly experience 20 to 30% corrections. Long-term investors understand this. Short-term traders react emotionally to it. If every drop scares you out of your position, you're not investing, you're reacting. 4. Most professionals aren't trying to pick the next winner. Retail investors often believe professionals are constantly searching for the next huge stock. But most institutional investors are focused on risk management, diversification, and consistent returns. Many funds aim to slightly outperform the market while controlling downside risk. Retail investors often do the opposite. They take concentrated bets, chase hype, and ignore risk. The irony is that beginners focus on maximum gains, while professionals focus on controlled losses. 5. Time in the market beats timing the market. This phrase gets repeated a lot, but many beginners still ignore it. Trying to perfectly buy the bottom and sell the top is extremely difficult, even for professionals. Markets are influenced by global events, interest rates, liquidity flows, and investor psychology. Instead of trying to predict every short-term move, successful long-term investors focus on consistent investing, diversification, long-time horizons, compounding works best when you stay invested. Key takeaway. If you remember nothing else from this video, remember this. The market isn't just a reflection of company performance. It's a reflection of expectations, liquidity, and investor behavior. Once you understand that, the market starts making a lot more sense. If you're new to investing, learning how markets actually work will give you a huge advantage over most retail investors. In the next video, we'll break down the biggest psychological mistakes beginner investors make and how to avoid them. If you found this helpful, make sure to like the video and subscribe for more investing breakdowns. And remember, the goal isn't to predict every move. It's to build wealth consistently over time.